Good evening, everyone. Thank you very much for your time. My name is Charlie Lee. I've helped with the management of my income for the last 18 years, and hopefully I'll be able to rattle through these slides and help explain the company and the investment opportunity. Next slide, please. Good. What is Murray Income? Murray Income is an investment trust that provides investors with exposure to high quality UK large cap and blue cap companies, and also has the ability to invest up to 20% of the portfolio in overseas listed companies. We invest through a quality income lens. We have a very experienced board of directors that looks after shareholders' interests. We're a member of the FTSE 250 with just over £1 billion worth of gross assets. We've been established for over 100 years. We're also an AIC dividend hero, so 51 consecutive years of dividend growth. And we have a very healthy dividend yield. At the moment, it's actually 4.7%, enhanced by the around about 10% discounts to net asset value. So on this slide, what I'm really trying to do here is just explain in a nutshell the investment proposition for Murray Income. So I call this the 3Ds. So we want to be dependable, diversified, and differentiated. So dependable in the sense of investing in high quality companies with resilient income and strong capital growth prospects, benefiting from a large investment team with full market coverage, very significant idea generation, and fantastic corporate access as well, both executives and non-executive directors, and also having a patient buy and hold investing approach, so allowing the fundamentals to win for income. Then the second is diversification, so not having all of our eggs in one basket, thoughtful diversification in terms of sector and income and capital per holding. As I mentioned, we can invest up to 20% of assets in overseas listed companies. And that's helpful in terms of providing access to companies and industries that you can't find in the UK. Also, healthy exposure to the mid-cap companies. We have a little bit of or a modest option writing program, which helps to diversify the income a little bit. And that typically accounts for about 5% of the total. And then the third is differentiation. So we feel that we're differentiated in terms of the quality approach, the diversification, the overseas listed holdings, the mid-cap exposure, like a little bit of option writing, and also ESG is very much integrated into the investment process. So we don't actually own any tobacco in the portfolio. And if you sort of amalgamate all of those factors together, you have a portfolio that balances capital resilience and down markets with the ability to capture structural growth. And over the long term, we've delivered appealing risk-adjusted returns. So you can see our 51 consecutive years of dividend growth, a record that we're very, very proud of. The trust pays dividends quarterly. We have a diversified income stream. It's probably worth mentioning that in the market, there's a little bit more of a preference for buybacks rather than special dividends, which is a little bit of a headwind for income, but it highlights, I think, importantly, the fact that companies think that their shares are undervalued. And then in terms of revenue reserves, they're attractive. So just over 50% of the full year dividend is visiting reserves. So you might have asked, well, 50 years of dividend growth is very good. How are you going to grow your dividend the next 50 years? So the aspiration that explains that is really on this slide. So Murray Income works on a very simple investment thesis that if a company in the portfolio wants to grow its dividends, it needs to grow its earnings. And we think that the quality companies are best placed to do that. And also, if they're helped with some of these longer term tailwinds, that's very helpful as well. So there might be aging populations or digital transformation or energy transition or emerging global hub. So on this slide, this really helps to explain the benefits of marrying together quality on the one hand and income on the other. So quality provides earnings resilience from business models with us balance sheets. and also strong ESG characteristics and an income is helpful in terms of being a valuation backstop and reducing agency risk for management teams that need to think about how they're going to grow the cash flow to pay their dividends over the long term. And in the middle of the Venn diagram, the outcome is strong long-term capital growth potential and attractive and resilient earnings and income. So just to provide a little bit of sort of independent evidence about the quality of the portfolio and its broader characteristics. So this is some analysis from Star Research, which looks at the portfolio and compares that to the benchmark, the FTSE All-Share Index, and really sort of three points to bring out. So the first one is the quality characteristics of the portfolio. So you can see the turquoise bars in the middle right. So a much better return on equity, return on invested capital, earnings growth stability than the benchmark. On the far right, the strong ESG characteristics. The portfolio is AA rated by MSCI for its ESG characteristics, no tobacco in the portfolio. And then on the far left, you can see value. So the portfolio is a little bit more expensive in the market as a whole. You can see the portfolio PE is 15.3 times. The all-share index is just under 13 times. You'd obviously expect to pay a little bit more for a better quality portfolio. But I think at the moment, with a discount at around 10%, you're actually able to buy a very good quality portfolio at virtually the same valuation as the market as a whole, and in absolute terms, that I think is also a very effective rating to be able to do so. Just a reminder of why want to be investing in UK the income, particularly the sort of siren call of the US and technology and the Magnificent Seven. So UK equity valuations are compelling. If you look at that compared to other markets, particularly the United States, and even if you sort of adjust for the various different sector differences, the UK companies, many of them have global growth opportunities. They've got strong competitive advantages, world-class standards of corporate governance. International investors are very much underweight the UK, and I think we have the potential for quite significant M&A activity as that value is crystallized over the medium term. And then in terms of why equity income, well, dividends, as all the academic research shows, are the key driver of long-term equity returns. Payout ratios are relatively modest, so dividends have the potential to grow from a strong base, although, as I said earlier, low valuations also encourage share buybacks, which is a good thing in many ways. And then when we think about equity income, we think about a quality income approach. So not simply investing in companies with high dividend yields, but those big quality companies that can grow their earnings and their dividends over the why quality? So the market often systematically underestimates the sustainability of returns from high quality companies. Good quality companies have good tailwinds, greater margins of safety, they produce less volatile earning streams. And that's important in terms of companies being able to deliver on their dividend aspirations. And they can navigate an uncertain future and capitalize on those opportunities to help create value over the long term. And when we're thinking about what quality means and doing our research, we look at 5 key metrics, which in many ways are proxies for risks. So, firstly, the durability and sustainability of the company's business model, the preference of the industry, strength of financials, management's track record, experience, capability, and then last but not least, the ESG risks and opportunities that a company faces. Just to talk a little bit more about diversification. So being not to be overly exposed to any one particular sector or company. So you can see here on the left, the sector exposure of the portfolio and its diversification. And on the right-hand side, the top 10 largest holdings. And as a rule of thumb, I'm keen not to have more than 5% in any one particular company. And although it's not... there is a slide to show this, but there's a very similar picture in terms of the income diversification as well. Talks about diversification in terms of some of those overseas listed holdings. So this is an example of Action Technology. So a company which would be very difficult to gain access to its drivers over the for investment in a UK listed company. So Acton is a Taiwanese listed network equipment company. It has some really strong growth drivers helped by the growth of internet data and artificial intelligence. It's got some very high barrier to entry, very strong financial quality characteristics as well. And as I say, very difficult to get exposure to that sort of dynamic, that sort of company, bigger investment in a UK company. Just to highlight the differentiated proposition of the company. So in Murray Income is unlike most UK equity income funds. It has larger mid-cap exposure, has that little bit of option writing to help augment the income, has some overseas holdings, that's for the better investment process, has this focus on good quality companies. It's diversified, patient buy and hold approach with low turnover, and attractive dividend yield, and also in terms of the trajectory and characteristics of performance, it tends to do best in market drawdowns. Talk a little bit more about those overseas listed companies. So just under 200% of the portfolio it is invested overseas, and you can see the holdings from the slide in front of you. Most of these companies are European, where valuations are, in many cases, actually as attractive as the UK, and providing access to industries that are very difficult to find as a UK-only investor. So, for example, MasterCard payments, Koenig elevators, L'Oreal cosmetics, semiconductors for BAT and TXML, and also industrial gases. So that is a sector we invest in through LP. Again, highlighting, I think the differentiation in the portfolio for an income fund, these exposures to these long-term megatrends, whether that's billion for aging populations, experience for digital transformation, road talk in terms of the energy transition, or Coca-Cola Euro Pacific Partners, for example, for its exposure to Indonesia and the Philippines and emerging globally. Just to talk through a few of the recent introductions to the portfolio. So DBS is the largest bank in Southeast Asia, has particular strength in consumer and corporate banking, and a very strong position in wealth management, very good quantitative quality characteristics, its high return on equity. Dunelm will be a familiar name, the leading home furnishings retailer, and has a very strong market position. New stores and formats should allow it to continue to take market share. And then just finally, London Metric, which is a 5100 property business with a high degree of exposure to logistics, which is an attractive area. It has a very entrepreneurial management team with a fantastic track record. Is the penultimate slide. So performance. So good performance on a risk-adjusted basis over the long term. The last 3 years have been a little bit more challenging given style headwinds and factor exposure. So in short, quality tends to underperform when bond yields rise, and that's something been heading for us over the last 3 years or so. But we're very confident about portfolio's ability to deliver long-term performance. Is the summary. So the 3Ds. So we want to be dependable. We want to be diversified, and finally, you want to be differentiated. And the discount currently trading at about 10%. It's an attractive opportunity, and hopefully that has explained the Murray Income investment case. And there's lots more information on our website, is murray-income.co.uk. But thank you very much for your time on listening.